Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. So I came across a chart this week plotting U.S. corporate profits as a percentage of GDP. It was fairly consistent in the 50 years post-World War II at around 6%. Then, in the mid-1990s, it hockey sticked up to where we are today, around 11%. That rise was in the wake of the creation of the World Trade Organization in 1995 and China's entry into it in 2001. Sure, lower taxes and technology-driven advancements are part of this story, but so is free trade. It may be at another inflection point as the move away from globalization takes shape. Something to think about. This week, our three things are: 1. Recession risk. For those keeping score, we've gathered the views of a broad cross-section of forecasters. We'll bring you up to speed on what they're saying. 2. C-suite sentiment surveys. There are divergent views. And 3. Time for credit. Performance data demonstrates the appeal of the asset class. All right, let's dig a bit deeper. Recession risk. Well, that changed pretty quickly. Recession risk is back on the rise, driven by fears that consumer and commercial spending is being impacted by uncertainty around trade tensions, the inflation outlook, and higher for longer interest rates. The Bloomberg consensus one-year recession probability forecast is currently 25%, which is about average, and up a tick or so from its recent low of 20%. Most of the respondents making up that consensus submitted their forecast a little over a month ago, right at the post-election peak in the stock market. Since then, the soft data has been increasingly worrisome. That's consumer and small business sentiment, ISM manufacturing, CFO surveys, etc. And markets have sold off, reflecting growing caution around the upcoming hard data. There have been many noteworthy forecasters taking up their one-year recession probability estimates. DoubleLine CEO Jeffrey Gundlach is up to 50 to 60%, as is Alan Blinder, economics professor at Princeton and former vice chair of the Fed. CNBC's survey of CFOs is at 60%. Former Treasury Secretary Larry Summers is at 50%. Morgan Stanley's dual mandate model is at 44%. JP Morgan chief economist Bruce Kasman is at 40%. A Deutsche Bank poll of 400 global market participants is at 43%. Mohamed Al-Arian, president Queen's College Cambridge and former CEO of PIMCO, is at 25 to 30%. The New York Fed's yield curve model is at 27%. Sitting below the long-term average is Goldman Sachs chief economist Jan Hatzius at 20%. For what it's worth, I'm at 25%. So what do we do with this information? Well, let's look back at 2022 when we had a similar spike in recession probabilities. Recall at the time, the Fed had ditched its inflation as transitory North Star and started hiking rates. Based on the history that hiking cycles almost always end up in recession, the recession probability started to climb in the fourth quarter of 2021 in anticipation of those Fed hikes, and credit spreads moved higher in lockstep. High yield spreads jumped from 274 basis points in October of 2021, that's when recession probability was a very low 10%, all the way up to 583 basis points by August of 22. By the way, that peak was 5 months before recession probability peaked at 68% in January of 23. So not surprisingly, spreads and recession probability are positively correlated. And bear in mind that the U.S. did not slip into recession despite the most aggressive hiking cycle in 40 years. Still, until we get a clearer signal that recession probability will flatten out and the U.S. can avoid a recession, look for the risk premium in credit to build. All right, on to our second thing, C-suite surveys. Now, 2 CFO surveys came out this week with differing degrees of concern about the current environment. The latest CFO survey, conducted in partnership by the Richmond Fed, the Atlanta Fed, and Duke University, had 345 to 390 firms across the country respond between February 18th to March 7th. For context, that period covered the correction in the S&P 500, so depending on when you responded, you might have had a very different view. In any event, the title of the survey is Optimism Falls Amid Concerns About Tariffs and Uncertainty. Interestingly, the optimism index for the total U.S. fell from 66 to 62. The average, by the way, is 60, while the optimism index for a CFO's own company also ticked lower in this survey, but remains around the longer-term average. As expected, The most pressing concern cited in the most recent survey was trade and tariffs supplanting labor quality and availability in the previous survey in the fourth quarter. Respondents on average are expecting 6.8% revenue growth in 2025. That's down just a touch from 7% forecast back in Q4. Interestingly, only 14% of CFOs are forecasting a recession over the next 4 quarters. That's up from Q4, where just 9% were forecasting a recession. Now think about that in contrast with our first thing and what that says about a C-suite member as opposed to an academic or investor. A very different view came out of the CNBC CFO Council survey, where its headline reads, "Recession is coming before end of 2025, generally pessimistic corporate CFOs say." CNBC's results were derived from just 20 respondents surveyed between March 10th and 21st. Again, for context, the S&P 500 bottomed on March 13th, so this survey period was at peak pessimism. Some 75% of those surveyed responded that they are somewhat pessimistic about the overall state of the U.S. economy. Moreover, 60% of this admittedly small group expects a recession in the second half of 2025, and another 15% expect one by 2026. In Q4, amidst post-election euphoria, just 7% of respondents forecast a recession in 2025. So some 90% of respondents say tariffs will cause resurgent inflation, and 95% believe policy uncertainty is impacting their business decision-making. What a difference a month makes. Over at the Conference Board, its measure of CEO confidence, that's done in collaboration with the Business Council, well, that was conducted between January 27th and February 10th. Again, for context, that's peak post-election euphoria. Its report is titled "From Cautious Optimism to Confident Optimism," reflecting results that hit its highest level in 3 years. At the Business Roundtable, its CEO Economic Outlook drew 150 respondents from February 19th through March 7th. While its index dipped modestly to a tick above its long-term average, it did forecast GDP growth of a robust 2.5% for 2025. The survey was quick to point out that more than 3/4 of responses were submitted before the 25% U.S. tariffs on Canada and Mexico were announced on March 3rd. Again, what a difference a month makes. All right, on to our third thing, time for credit. So we've talked about this for some time now, that for the first time in probably 15 years, the time is right for fixed income. Following the painful correction in rates in 2022, yields in fixed income in general and credit in particular have once again become attractive. Attractive in that they can once again assume their role of providing meaningful income and diversification to portfolios that had become loaded with equities. And now the asset class performance data has become quite interesting. Year to date, the S&P 500 total return is down 2.6%, reflecting its correlation catalyzed by the shock of policy uncertainty. The said shock of policy uncertainty so far has been sufficient to reduce some of the froth in the equity market, but not enough to materially alter risk and reward in credit. So far this year, the Bloomberg IG index has produced total return of a positive 1.7%. That's outperforming the S&P by 4.3%, while the Bloomberg High Yield Index has returned a positive 1.5%. A 60-40 portfolio made up of 60% Bloomberg Large Cap Equities and 40% of the Bloomberg U.S. Ag Index has, not surprisingly, also outperformed the S&P by 1.8%, although its total return of a negative 0.8% is being weighted down, of course, by the equities component. We probably know enough by now to conclude that 2025 is likely to be a volatile year in markets as investors, both in the U.S. and abroad, try and dimension the effects of the new administration's policy transition. We also believe we know enough to say that stocks and bonds are likely to be negatively correlated, which is a way of saying that the downside to risk is contained, i.e. not positively correlated, where everything sells off. The starting point for this economy is too solid. But as we have said recently, we are normalizing, slowing down, and the global economic and geopolitical order is being remodeled. Sounds like a good time to be in credit. So there you have it. 3 things in credit. 1, recession risk. Market participants are clearly moving probabilities higher. A lot would have to go wrong here quickly for that to be the case. We're comfortable at 25%. 2, C-suite sentiment surveys. Sentiment is clearly reflecting a growing conservatism. And 3, time for credit. Demand for income and diversification and solid, if unspectacular, returns is on the increase. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.